Thank you for listening to Mailbox Money, your guided tour through safe, sacred, and speculative investing with a plan and a purpose to do more good with newfound peace of mind. All right, everybody, welcome back to another episode of Mailbox Money. I'm Jackson Wood, joined this time by my partner and co-host, Ryan Kruger. We're excited to have him back. Took a little break last week, had Nate on. But this week is going to be a fantastic episode. I'm excited about this one. We're going to do an incredibly deep dive and just kind of paint the picture for everybody about what is happening with safe money. And you've heard us over and over and over again talk about our simple portfolio, which is safe money, sacred money, and speculative money. And safe money is oftentimes the boring component that people don't enjoy talking about until the last 2-3 weeks. It's been the only thing that people have talked about. And so what we're going to do is we're going to go through everything about safe money, how safe it is, our approach, how to understand what is going on. If you're a beginner or just trying to learn this stuff, or you're an incredibly sophisticated CFO or portfolio manager, I guarantee you there's something in here that you can learn from. Ryan is locked and loaded, ready to go with some good data here. So what we're going to do is just kind of go over broadly what is going on in the world of safe money, what happened recently, and what we can learn from that. We're going to talk about our solution, and you've heard us on this podcast, I'm thinking as early as episode 4, our solution of, bank yourself, become the bank, understanding the ins and outs of safe money, how to build it into your portfolio. We're going to talk about how there can be bank runs, but how there cannot be bank runs when you are the bank. That's going to lead us into one of my favorite topics, the best kept secret off of Wall Street, and why both Ryan and I ran the other direction after starting our careers there. And then how this safe money part of your portfolio unlocks upside for the rest of your portfolio and allows you to take the appropriate amount of risk to benefit from the market and from investing. So with that overview, and with the time that we're in right now, I think this is going to be a fantastic episode. I'm excited for it.
Well, having lived through a couple of these financial crises myself as the elder statesman and inside the belly of the beast during the last true credit crisis, this is likely a more isolated event, but I think the lessons are always each time we can learn something new, in particular, if we're willing for anybody listening to this to accept what we don't know and some of the secret ingredients to the holy grail of deeply informed simplicity. And it starts with, and Jackson always beautifully lined it up, safe, sacred, and speculative. And that is not too simple or simple for simple's sake. That is really the key to avoiding all this mess. If you look back through time, if you go deep into the weeds and all the footnotes like I like to do, or just observe it casually from the sidelines, they're all centered around the safe money really wasn't safe. And either your counterparty, which we now know is a risk in any exchange, or yourself, they're accidentally or on purpose speculating with some of the safe money. And maybe they're skipping the sacred. And so we always like to simply divide it first. And the question we've always said that most folks, from the most sophisticated investors included, get wrong when we ask them on a forensic accounting deep dive is how much of your hard-earned nest egg is completely removed from harm's way. That is the one question that most people consistently get the most wrong. So our definition of what really safe money is, it's only during one of these crises that it tends to matter. So all those other years you can tune out, the safe money, the safe money. Well, let's walk through first what happened this time, because I think there's some specific lessons that we can learn. And most of them rooted in more humility is going to be the answer. But in this particular case, with a bank with a heavy concentration in venture capital, hot money getting deposited. So the bank was getting an incredible amount of deposits over the last couple years, fueled in part by artificially low interest rates. And some people want to blame the government and talk about the Federal Reserve and all the conspiracy theories, and it was their fault. Some people want to talk about the greed and venture capital and throwing good money after bad deals without the due diligence. Some people want to blame the bank for not doing due diligence and loaning money to companies that were not even profitable and shouldn't have gotten loans in the good old-fashioned banking world. What about this idea? Any of these crises take co-conspirators. It's all of those things. So rather than point the finger, I'd like to share with you how Jackson and I remove ourselves entirely from those questions. And that should be the goal. It has nothing to do with us. These simple ingredients you can do on your own, or as we'll talk about, all of a sudden, the much needed true definition of a fiduciary needs to be looked at, which we're going to do today also. So you have these hot money deposits flying into the bank, more than they were really prepared for and that they bought bonds with. They happen to perhaps make a poor decision with discretion to buy longer dated bonds than keep cash ready in short-term bonds. They have to be risk-free for the bank. There are some real good lessons that most good banks stand the test of time for a reason. They weren't speculating with at-risk issuers of bonds. They happen to make a poor choice on too long a bonds. We'll talk about here in a second. Then, when interest rates weren't low, money wasn't flying at venture capital funds, and these companies were burning cash and needed to meet payroll and were taking those deposits and needing them back, people should be able to be reunited with their money, which we'll talk about here also. The bank was in the unfortunate position of, oh my gosh, we had more people ask for their money back, $40 billion in one Friday afternoon, than we were prepared for with short-term cash on hand. So we'd have to sell some of our bonds. If we sold some of our bonds, we'd take a loss because of the direction of interest rates, and we'd have to disclose what we're doing, but it would shore up the problem. And just that whiff of, oh my gosh, would it trigger more losses? And would they not have enough to meet depositors' demand to be reunited with their money? A bank can go upside down in shareholder equity and be worth nothing in a matter of hours. So it wasn't safe money from customers with well-funded balance sheets to begin with. The bank should have known that. That was their fault. The bank didn't keep enough safe short-term money at the ready for the customers that were lighting money on fire and needed more. In both cases, it wasn't safe money, and both are at fault. I don't want anybody listening to this at another bank or in another situation to be caught in that crossfire. And so we're going to talk about a solution today, in a simple one. There's no exotic hedges needed, no fixed income products. All of these Frankenstein funds that Wall Street preys upon savers with during a low interest rate environment for more yield, run, don't walk. There's an easier way to do this we're going to show you today. But first and foremost, and if anybody laughs, and I've had people laugh at me during meetings before, I've also had people cry, do not think that this is dumbed down for simple sake. I have the same sketch pad for officers of publicly traded companies who don't know how to read their account statements and don't actually know how a bond works. So if you're willing to share 1 minute of how a bond works, don't give yourself some grace. The fact that you might not have actually known what that interest rate risk was or how it works, let me draw exactly what I do in every one of those meetings, because very few people, and I mean a handful, small percentage of American households, own their own bonds in their own name, in their own account with no middleman. That's what we mean by bank yourself.
Yeah.
And if we opened up the movement on the bank balance sheet, no different than an individual account holder, how does it work? So the beginning of last year, if you bought a bond that was a longer dated treasury bond, am I doing this right, Jackson? Can they see it?
Hold it back just slightly, like at where you back your chairs. There you go.
Okay. I've never done this before. I'm not good at visuals. My handwriting's not great, but that is a 2% treasury bond. Bonds come in denominations of $1,000. So anybody thought I got to be a rich guy or gal to have a $100,000 bond position. Those are 100 bonds. You can buy bonds in any denomination you want at $1,000 each when issued that mature, and you're guaranteed by the Treasury to get your $1,000 back. In this case, it was a 20-year bond, and you get 2%. This bank and a lot of others had a lot of those bonds. If 1 year later, your next door neighbor, for any reason, Don't get caught up in inflation, interest rates, Federal Reserve. The bond market is the thermostat on the wall. If you want to know the temperature, just go look at where the bond market is and let everybody else waste their time on opinions on what the Federal Reserve is going to do. The bond market has already told you what it is. And there's a bid and an offer and a liquid market for bonds. So if 1 year later, if your next door neighbor came and said, I want to buy a guaranteed treasury bond, same terms, 20 years, I give you $1,000 and now I'm getting 4%. That was the current interest rates 1 year later. In both cases, both of those bondholders, if they wait, they're going to get all their money back. One's going to get a little more interest than another. If a bank or a mutual fund or a fixed income product has a bunch of people say, I want my money back earlier, especially if they've used leverage or borrowed funds and now they got to sell a lot of bonds fast, what happens to this first bond that was purchased, if it was sold at the end of the year when current rates were now at 4%, the bid would be $760 or thereabouts. That is, if anybody looks on any online tool or chart, that's a long-term. I just use the TLT, long-term bond ETF. You lost 26% of your money, 24% year over year. And this was not isolated to one bank. According to the FDIC, banks had unrealized bond losses at the end of last year of $620 billion. So if a lot of banks or institutions were asked, I want all of my money back, and had to trigger losses, this was an isolated, unique incident because of the hot money and the customers, bank's fault. They had too many cash calls and need for a return of their money too fast, customers' fault. Anybody caught in the middle of crossfire, especially if confusion, if you've never even heard of this bank and you have none of your money there, oh my gosh, what's happening to my bank? What could happen to Charles Schwab, which we'll talk about as a big, all these other banks? I want to remove you from all of those confusing conversations. And we're going to try to do that today. But I wanted to start, Jackson, I hope I did a decent job of not boring too many people, but this, how that bond works, and one of the most liquid markets. There's no quotes during the day of where the bonds, until this matters. And oh my gosh, you can lose that much money in your fixed income products. Done the wrong way, it is the exact opposite of safe. There's more risk, especially when folks didn't think they were taking risk with the conservative or fixed income. And that's why none of those, those questions of risk tolerance and conservative versus aggressive, I'm so allergic to any of those for reasons exactly like this. We're going to unpack and understand the actual organic ingredients, not words and titles and glossy brochures that get ripped to shreds during periods of time like this.
I remember, well, now everybody knows why I call you the black belt, the professor. I love, and I want to show them the whiteboard at some point. But I remember when I used to see these bond products or fixed income products come across, and a lot of the people selling these things would call them, it's risk-free return. It's risk-free return. Look at the underlying holdings. And it's not until you understand the mechanics of what can happen here, especially when interest rates go up, that risk-free return turns into return-free risk in these cases, right? There are a lot of people out there in their portfolio think that TLT is their safe money and they're conservative. It did worse last year than the market, the stock market. It's unbelievable. I think we have a podcast that says it was the worst year since 1978 or something like that. And it's just outrageous. And people think these things are safe and they're not. And we have been preaching since day one of the podcast, bank yourself, understand how to do this and it is possible to completely eliminate the risk and make sure that you have this pile of safe money and what that truly means. And that's where even boards of companies that held their cash with these banks didn't understand what could happen here, or they get paid hundreds of thousands of dollars a year and they couldn't come up with a recommendation to move something into a short-term treasury and out of cash. So the good news is this simplifies and it all boils down to something that works and will continue to work into the future and gives peace of mind when we need it the most.
So these all take co-conspirators would be one big takeaway that anybody needs to humbly think about. And rather than, you notice, I don't want to focus anymore on one particular failure, because these things continue to recur for a lot of greedy reasons that take co-conspirators. So this latest failure, I couldn't help but notice, because I was there and I vividly recall it happened exactly on the 15-year anniversary of Bear Stearns going under. And that wasn't a new bank in venture capital land. We're talking about an 85-year-old legendary institution that previously a Wall Street long-term veteran would have told you would have been the ones never to go down. And there was other firms like that at that time. I want to when I said give yourself some grace to realize and smartly start to eliminate what you don't need to figure out, because I think that's this peace of mind we're going to try to unlock here today. Since that time, living through that, I want to give you exact updates. So I'm going to look. Yeah. Okay. So exactly 0 Federal Reserve predictions, bull markets, bear markets, interest rate calls, correct hedges, products, or any of these safe yields have I had one opinion on since Bear Stearns to this latest crisis. And when I say bank yourself, it stayed consistent. What I learned in the belly of the beast is if you can just take the exact same ingredients, they're not the problems. We're talking about a tax-free, beautifully boring municipal bond here in a second. It's been around for over 200 years. It's everything that Wall Street has invented on top of that, then with leverage and egos, that has caused the problems. If you're able to extract those organic ingredients, farm to table, own them yourself in your own account, you eliminate these layers and expenses and risks and confusion. And it really is as simple as that. So when I say bank yourself, and when Jackson and I mean, and we walk through, whether it be a brand new individual investor that never thought they could own their own tax-free municipal bond on their own account because nobody on Wall Street's telling them that anymore, or a extremely successful, huge nest egg where eliminating any little layer of risk, cost, or taxes could be a 6-figure or more job per year of extra income coming in without having to do anything. In each case, at each extreme, it's the exact same solution. Take out the middleman. That's what I mean by bank yourself. The exact same insured deposits that they will own on their balance sheet, and not having anybody dictate any runs or force sales in your own name. And then cash reserves, which is a hot question, hot button all of a sudden. Where is ours? Where does our... Let me be clear. Banks will stay around, especially the big ones, for a long time. And I do still have a personal bank account for a lot of good, not terribly disruptible reasons. I just don't keep a lot of cash there. I don't want to be paid next to nothing, and I don't want to participate in everything we're talking about today. So my real cash reserves are in money markets of a private business. And we'll talk about, let's real quickly, the role and reminder that a period like this puts right in our face, and where the footnotes, you can do this on your own, or you need to find a reliable guide or a partner that really can clearly identify what that word fiduciary that gets lost in the shuffle or overused, frankly. In investor advisor world, I think it's used more as a marketing discussion than real definition of, I want to be clear that these banks are not evil. And people will be surprised for me to say that when I escaped one and we're telling you all the things they do wrong. Their fiduciary obligation is to make money for their shareholders. Jackson and I, if there's any greedy bone in our body, full confession, this is the episode for you. I'm going to surprise the heck out of you. I don't mind that, because we're going to tell you how to remove your safe money, but then profit from it because they pay dividends during all of this, because they are a for-profit for the shareholder operation. That if they happen to also take care of customers, too many of whom are too lazy to ask these questions, they're not delighting customers like most businesses have to do. They do just fine, and they do fine for a long time. I would rather find in my life, for any other expert needed guides, just like a lot of folks listening to this on the investment side, find a truly objective, independent fiduciary guide, not corporation trying to make money for their shareholders. Jackson and I can speak from experience. We are one. We've always been one. So this is easy. This is like breathing oxygen and drinking water. I'm not too proud. I'm not taking a victory lap that we're fiduciaries. But I think that definition comes up. Like, I think a lot of people were surprised that that is what's happening when some of these yielding accounts, even money markets at brokerage firms, if it's publicly traded, they might be swept into a lower yielding alternative without asking you to make more money for the firm. I would much rather avoid all of that too. So I would like to be in a non-publicly traded money market, which is safe for the cash reserves portion next to our beautifully boring bonds. That's where our safe money is on the liquid side. Did that make sense? I need help on this because I'm usually talking equities and dividends, but safe money, I want this to be a dialogue too.
Oh, yeah, that makes perfect sense. And one thing that I will say about this safe money and cash and brokerage accounts, it's fun to actually see this have a yield. I don't remember a time in my career where I could get excited at all about yield on cash. And, to me, that just makes complete sense. And money market over bank, I mean, obviously people need bank accounts to live and support their lifestyle, but we're talking in your portfolio, the safe money right alongside these AAA rated insured municipal bonds. There's a money market account and it has a yield and it's liquid and the interest goes to you, the shareholder. And to me, that's just a powerful combination. And that's the upside of this. Everybody's been talking about the downside of rates and, just painting this completely negative picture. But I've had probably 30 conversations in the last month about, hey, did you know that your cash in this account has a yield? And everybody loves that. It's fantastic. And so it just again, when you align your safe money correctly, it gives you peace of mind. There's yield there. It's optimized. You cut out the middlemen so that you get to participate in all of the income that the portfolio generates. It doesn't go to Wall Street or doesn't go to fund managers. You're not relying on anybody to time this correctly or hedge or do any of that. You sleep good at night. And that to me is the purpose of safe money and kind of builds this moat and it feels good.
And it requires you or somebody you can trust taking an active role because this is, savings account, we're not supposed to require you becoming a chartered financial analyst or getting your accounting degree. And if you listen to the noise and the distraction of the last couple of weeks, and it's hard not to, and I'd be scared too if I didn't know, you're led to believe that's exactly what I'm supposed to do for my family. And I think once again, it's usually on the greed side on the equities, but in this case, fixed income, and it comes up every decade or so. I think once again, our industry has done an awful lot to earn good, real families' distrust. And that makes me upset. And that's why I get a little bit animated because the real simple solutions have never changed. They're right there. They just don't talk. They don't talked about that much. And that's one of the reasons we escaped. I couldn't do this inside, at the time, the biggest bank and brokerage. My last deal breaker and what it meant to me, because everybody's going to have this point in their own lives at some point on their accounts or their relationships or these confusing institutions. I voted with my feet and I left all sorts of enhanced yield to keep today's topic behind. I didn't want to be greedy. I left a lot of cash bonuses offers behind when I understood what I was now a part of at this big giant Wall Street firm versus what I could become as an independent true fiduciary. My last clue and my last hint, I think I've shared this before, was as a hint to where your money is best placed. I could no longer sign off a personal note, your partner, Ryan. And I couldn't say where my own money is. Think about that. And so this podcast is for you. We're going to share exactly where all of our money. I'm excited to do it because this shouldn't be that difficult. And this should be liberating and exciting. And people should be, when they understand something, it becomes a lot more powerful. And then you can explain it to the person. If you can't draw it on a piece of paper to your spouse or kid, you shouldn't be invested in it. And I really do believe that. So number 3, no crowded lines, no runs on your bank. This is, I don't like crowds at all. So this is going to be real simple. For all of the great sounding, because you'll hear them again, especially when rates start coming back down again at some point, all of the fixed income products, some of which preying upon desperation for yield, which we just went through in a low interest rate environment, will end up in class action suits because they're riddled with all sorts of exotic leverage and confusion that was not properly explained. For all of the next safe, great yielding, crowded fixed income products, I would ask two questions, the only two you'll need. How much of that, by definition, and I want you to show me exactly what it is with full transparency, how much is 100% risk-free? There's only a couple ingredients in the history of time. 2, how am I reunited with my own money when I need it? And just listen and let somebody twist themselves into a pretzel, and you'll quickly realize if they can't explain it clearly, run, don't walk. What bothered me most about this latest crisis, like the last one before, is somebody unintentionally, we talked about the two forms of greed earlier, both the customer and the counterparty, the co-conspirators. Somebody that was not a part of any of that shouldn't be forced to scramble in line to get their own money back with those two. So avoid them. Get yourself away from them at all. I will never, ever, ever have to be involved in crowd dictating that performance, nor in the liberating part is I don't care what the Federal Reserve thinks about it. I don't have an opinion. And we'll talk about that here in a second. The best kept, well, you mentioned it earlier, Jackson. So spoiler alert, the best kept secret off Wall Street. I said it, and I have interviews in writing from 2008 credit crisis. And I said it'll be the exact same next time, because 2 or 3% of American households even own their own tax-free municipal bonds. I think it's the best kept secret off Wall Street. It's what is in my savings account right now. I don't need to be a CFA or a forensic accountant for something that's AAA rated and insured. I don't need to pay for a big family office or tax professional or scramble to build all sorts of exotic estate planning solutions. If it's tax-free, that's a lot better than tax-deferred or tax loopholes, of which there's all sorts of products that come at people for those too. Tax-free is simple. Risk-free is simple. That's the most beautifully boring example. When I don't need that money this year, I can stagger it. I showed you the denominations earlier. It could be any size, it could be any amount, it could be any maturity. And anything that I might need and I want to plan for unplanned expenses, I'll have in money market. So that's my safe money, where 100% of it is.
I'm trying to hold back my excitement because I know a lot of people think that municipal bonds are boring, frankly. And I never got too excited about them until, I realized what these can do. But I think this is a good segue. If you think about your portfolio and you visualize it and you envision there being a pile of tax-free municipal bonds, there's no duration risk. There's no one telling you when or when you can't access it. They're not bundled into a fund. Pile of cash reserves in a money market with yield to cover emergencies in the event that you need it. It's liquid. It's there. You get the yield. It doesn't go to a bank. If you think about that as your foundation, the rest of the market and the fluctuations and the fear and the volatility doesn't concern you. And this next section, it's the key to unlocking more upside. To me, that's where it starts. That's the essence of this. And if you can operate from that position, the entire journey of financial planning and investing becomes much more enjoyable, and you probably like it. And you sleep well. I say that over and over again, but I truly, truly mean that.
Hey, and lost in all this shuffle is it was actually the low to no interest rate environment that was the most conflicted and the most artificial and had more problems. And if you remember, we quickly forgotten how much we were hoping and begging for an economy to not be so slow, so that higher interest rates are a good thing. Only levered bets against them cause these problems. So if you did have more than enough in cash reserves and money market before this disastrous year for the bond market that has had all sorts of ripple effects, and we're not done yet. Just real quick update on that 24% loss that started this ripple effect and this big bank run. If you have your cash reserves, the ones that you need, liquid in money markets, you actually got a pay raise last year. Your 1% went to 4%. So you quadrupled your money on your savings account, and you really can safely acknowledge and ask yourself, any time somebody has a reason to be concerned, you can look at them like, I don't know what you're worried about. I don't have to participate. I'm not going to let the crowds. And I think that, and we said the key to your safe can surprisingly unlock more upside. This is where I'm not a psychologist, although I just hung out last week with the smartest behavioral financial psychologist in the world, which was phenomenal. I've got Brian Portnoy and Neil Beige on each side of me. And they talk about funded contentment. I was overfunded. It was like, that's where everybody needs to be at a dinner like that. This topic never, ever, ever came up. So I am unqualified to say what I'm about to say. I give all the credit to the folks that study the brain and how this works. And I'm the math guy. So I just like hanging around in that crowd. But I can tell you, because I've just witnessed it, I've seen it, what better, simpler math can do without any of my help, without any of my psychology. I think the biggest surprise would be if you take care and make your safe money truly safe. And we've tried to share how we do it today. It's not the result that people that secretly don't want to be too conservative and don't want to have too much safe are worried about. It's that discipline and that true risk-free safety that will unlock more upside. And here's what I mean by that. I'll just speak personally in my life, what that discipline, humility has helped me get through every credit crisis and the next one. And the ingredient that I learned and found that is in shortest supply on Wall Street, one of the reasons I had to escape and don't like crowds, is the following sentence. The most underrated investment sentence I believe out there. And you will not hear this from any other expert, I don't think. If you do, I want to talk to them. I want to eat dinner with them too, because that was what this crowd was all about. It is, and I quote, and I say it all the time, I do not know. If I imagine anybody listening to this, if you could create an alternate universe where every single time you had a confusing question like we've gotten the last couple of weeks, and then all the opinions on TV and even your peers and maybe even your house peppering all the predictions and the convictions and what should happen, if this alternate universe, you created this crazy fictional world where you got $1 of earned interest for every single one of the opinions and predictions that you can now, for here to eternity, ignore. That peace of mind and the interest you're earning on the safe money, to not get away from the math part. Yeah, I honestly believe the perpetual maturity of that peace of mind, to compare one last bond market, and the time you could buy back has exponential value to explore opportunities while everybody else is panicking. Might there be some assets or opportunities outside of the safe sleeve, which you've got knocked out, in the sacred or even speculative sleeve, that you could take advantage of what will never change, the crowd's reactions and confusion and distractions? If you can eliminate all of them, I think you'll find, as I have, with eyes wide open and seeing and hearing things more clearly, that can only happen through peace of mind. No extra charge for the amateur psychology portion of this program. I could be sued for malpractice. I'm not a licensed in any way psychologist, psychiatrist. I'm just sharing what I've seen happen and the peace of mind it unlocks in folks. And that is really, if anybody wants to know like why I get so, that's my juice. That's where I get my aha moments. Like, wow, that is it. That is what we're doing this for. It's supposed to be a tool not a source of confusion. That's what money and the safe money should be. It should be a tool to go unlock. So I'll stop there.
The thing that pops to mind, I know you know what I'm about to say because it was in the High Jump blog and on our website, but Jocko Willink, when he says discipline equals freedom, that's just going through my head a million times. And I think that is incredibly true in life, but it's also true with money and safe money. So I think we need a t-shirt with safe money and maybe Jocko's face on it. I think that could be our next merch drop. If anybody has any questions for us, would like to chat with us, would like to build your own safe, sacred, speculative portfolio, the simple portfolio, you can reach out to us, schedule a meeting with our team. It's team@freedomdaysolutions.com is the email. And then, as always, our website is posted in the show notes, freedomdaysolutions.com. If you like this episode, we definitely appreciate if you subscribe, like the show, or share it with a friend. And with that, and all the madness, we're going to leave it behind. Have peace of mind for moving forward. With that, we will see everybody next week.
This show is brought to you by Freedom Day Solutions, LLC, a registered investment advisory firm advising individuals and families nationwide. Performance is not guaranteed, and past results are not necessarily indicative of future performance. To learn more, visit freedomdaysolutions.com. This show contains general information that is not suitable for everyone and was shared for informational purposes only. Any forward-looking statement or opinion expressed is subject to change without notice. Nothing contained herein constitutes investment, legal, tax, or other advice, nor is it to be relied on in making investment or other decisions. Clients of Freedom Day Solutions may hold positions in the securities discussed.